Well, the markets have been climbing, but do the numbers reflect the realities of the global economy? My next guest knows what signs to look for. Bob Gelfond is the chairman and CEO of MQS Asset Management. Bob has more than 2 decades of experience as a quantitative strategy developer. Bob, thanks a lot for coming in to talk to us. So first of all, I want to take a little bit of a step back because you're a quantitative guy. You're looking at algorithms to drive your trading. So how much does this sort of macro view play into what you do, your view of the economy?
In what we do, that's all that we do. We don't. There are other quantitative types of traders that look at price action, things like trend following or mean reversion. We don't do any of that. We really just analyze economic fundamentals for the countries that we follow, and then take our positions based on that. Really looking for relative value rather than trying to pick the stock market or gold or what have you.
Well, let's talk about the overall market for a second, because obviously we saw the market pull back somewhat on concerns about Japan, concerns about oil prices, and then we've gotten back a good amount of that pullback. And it does seem to reflect a lot of optimism about the economy and about corporate profits. Is that justified?
I think some of it is justified. The economy is clearly growing, but part of it, I think, is really the Fed is really juicing the system. They're being very aggressive, both with their quantitative easing, of course, but just with keeping interest rates very low, and that's creating price signals that are getting noisy. It's hard to distinguish what the real economy is doing versus what the Fed is causing to happen from flooding the system with money, and that can be the tricky part in trying to disentangle those two phenomena. But I think the economy certainly is growing and is on the repair, although not as fast as we'd like to see it, particularly at this point in the recovery.
Well, I'm curious about something like consumer spending in particular. I mean, we did get some spending numbers out today that the market read is relatively encouraging. And yet, if you look at some of the retail sales numbers, you look at some of the other consumer indicators, we're not necessarily seeing the strength that you would want at this stage of a recovery. Is the Fed, in terms of its effectiveness, run out a little bit when it comes to consumer spending and confidence?
I think it's not just the issue of the Fed. I think a lot of what's stopping the economy, or the headwinds that the economy are facing, are actually a result of the fiscal policy that's been going on. The increases in spending, the increases in regulation that we've seen, not just even under Obama, but even going back to Bush, really create tremendous headwinds. They make it harder for companies to hire employees. They make all sorts of things harder for companies to do. They reduce the efficiency of the economy, and I think that's one of the biggest reasons why the economy isn't moving as fast as you normally see at this stage of a recovery. Normally, we'd see unemployment dropping much faster. We'd see the economy growing much faster at this point.
I'm curious, are you seeing that in your business personally, that you're more reluctant to hire because of regulation?
There's some times where it makes more sense to hire people as consultants, but the spread between what you pay somebody and what they actually take home is a big number, let alone other overhead, non-monetary overhead, compliance issues and things like that. So
I want to go back to the Fed for a second and what you talked about with pricing. You actually think a little deflation is not a bad thing, whereas obviously the Fed wants inflation to be at least at 2%. Why aren't you concerned about deflation?
The Fed, as well as I think the overwhelming majority of central bankers, want to see inflation above 0 because they feel it gives them a little leeway in case the economy starts to slow down, because you can't bring interest rates below 0. But in a growing economy where you have productivity increases, you should see the price of goods drop once you adjust for quality improvements. And when you're not, it's sort of a hidden inflation almost. And I think that was part of what happened in the 90s when we saw the bubble in the stock market. It's clearly what happened in the mid-2000s with the real estate bubble, because the Fed was only looking at CPI and wasn't looking at productivity. They kept interest rates too low. I think that's also what's happening now. The interest rates, I believe, could be somewhat higher. And I'm not talking about a deflation that comes about the way we had in the 1930s, where the economy is truly starved for liquidity, but just a very slight deflation, maybe something on the order of 1%, that truly reflects the productivity increases that we see over time.
So if the Fed continues on its current course, if we see QE3, for example. What's going to be the outcome in the economy? I mean, do you think we're going to see a spike in inflation that's going to really crimp the recovery we've got going?
It's possible, but I think the biggest thing that the Fed is adding is a lot of risk into the system. So it doesn't necessarily have to play out in a big spike up in inflation. We could have almost a repeat. It won't be an exact repeat, but something along the lines of what we saw in 2008, where you actually end up with a deflation or a big spike down in the markets as people become scared, as risk gets taken off the table. In a very small way, what we saw a few weeks ago with Japan and with what was going on in the Middle East. People get scared very quickly, and all the risk bets that they make quickly come off the table, and that can actually drive a deflation.
All right, Bob, thank you so much. Appreciate it. Bob Gelfond of MQS Investment Management.